Hello everybody and welcome to Stellicum Investments. My name is Magnus Brandfors. I am the president of Stellicum Investments and I work through my broker-dealer Commonwealth Financial and clearing firm Fidelity Investments. I've been an advisor since 1992. I primarily do discretionary portfolio management for investors on a fee basis, serving generally a limited number of high net worth retirees. So today, this video is going to address a generally happy topic, and that would be what to do when the market is soaring. When investors find themselves in markets that are particularly rewarding, several steps may be prudent in protecting those gains, but also to make your investment experience more rewarding and meaningful in life. So let's cover a number of these subjects and how you can employ them for your benefit. So some of the things that you can do when the markets are being particularly rewarding are going to be kind of defensive in nature. Pretty much every single time I meet with clients, one thing I ask them is, how much cash do you have on hand? How much savings? And generally speaking, a person should have, at a very minimum, 3 to 6 months of living expenses in a bank account as a retiree. But if the market has been particularly rewarding, maybe it's time to bump that up. Realize that in a particularly bad market, your dividends may be cut, your income, cash flow, investment gains may be muted to the point where you would rather not touch your investment portfolio for the fact that it's down in value and would rather live off of cash savings. So to have a cash cushion of up to a year or even 18 months may be a good idea. Another place a person could go with a windfall of returns is paying off debt. Perhaps as the economy was improving or climbing, you decided you were going to go buy a car or a boat or do something that you put on a payment plan. Well, now might be a good time to simply say, hey, let's cut that a check and pay the entire amount off. Maybe it's time to pay off the entire mortgage. But in any case, paying off debt is a great way to deploy capital in an efficient manner. Another thing to do is to reward yourself, to buy things that you want or buy things you need. For example, you may want a new car, you may need a new car, you may require having a new car, the roof on your house. Generally speaking, though, it would be nice if you can buy those things when they're not extremely expensive. Right now, this is June of the year 2021, and right now, due to the nature of post-COVID, we're seeing pretty rapid consumer inflation. So right now, buying any sort of a luxury good or even need items, the prices are being marked up. And it's maybe difficult to even find services. So in a booming economy, it may be difficult to buy things at a reasonable price. I have seen bullish stock markets where the prices of things like cars and luxury goods have been cheap. Well, in that case, buy the things you want or need in a market like that. One thing that a lot of people don't seem to ever consider is one way to deploy capital very efficiently is to prepay taxes, especially if you think taxes are going to go up in the future. So for example, you may have $100,000 worth of stock with $75,000 of that maybe being a capital gain. Well, what if you sell the stock now and simply pay the gain on it today at a fairly small capital gains rate, as compared to waiting for the future when that capital gains rate or taxation method may increase. There have been times in the past where it has been known that the rates were going to go up. The last one I recall was under the Obama administration and the Obama healthcare taxes that were added on there. In that case, we went to clients and had them sell stocks to front up the tax payment before the tax increase the next year would get even more money from the client. So now what if you want to keep that stock? Yeah, I've got $100,000 of that stock, but I really like it. There is no law that says you can't just sell it and buy it right back. You will have raised the basis. So if this is a $25 stock trading at 100, you have 1,000 shares of this for $100,000, you could simply sell those 1,000 shares and raise the cost basis from 25,000 up to 100,000. If 3 years from now the stock's fallen to 75,000, now you have a $25,000 paper loss that, should you choose to use it, you could realize it and offset other gains or take the taxable loss. So there is a bit of a tax strategy that can be played. Certainly, when the stock market's doing extremely well and you've been rewarded, what can happen is your portfolio becomes a bit lopsided. Your growth investments have grown more disproportionate to your more conservative investments. So at this time, potentially, the wise thing to do is to start reallocating some of your money into the more conservative or undervalued areas of the market. Even most bull markets, there usually are some bargain areas that can be explored. You dig a little bit and you find places where there may be bargains. The side benefit of that is, should there be a market correction, those already cheap areas may be more defensive and not see as big a price downturns should and when the downturn come. When I talk about a more conservative allocation, if on a scale of 1 to 10, 10 being aggressive, if you have been an 8, I'm not necessarily talking about going to a 2. Going to a 5 or a 6 will at least be some sort of a measure of making an allocation change. In extremely bullish markets, most investors, they find it painful to take the foot off the gas pedal. It's what they're supposed to do, but a lot of people struggle with doing it. In my case, I am a portfolio manager. I do it for them. Decreasing equity risk. For example, not every stock portfolio is the same. In a risk measurement standpoint. A person that has $1 million worth of stock in 2 companies that nobody's ever heard of is a lot different than a person that has the money in a portfolio that's diversified by dozens, if not hundreds of stocks through mutual funds. So increasing the number of allocations, increasing the diversification scope. For example, that means maybe covering geographic regions that you aren't already covering. Smaller companies can be more speculative than large companies. Maybe you decrease your exposure to aggressive small cap stocks. Value stocks are generally less risky than growth companies. So maybe you make an allocation change from growth into value. There are a number of different ways a person can decrease portfolio risk within equities. And the same can be said for fixed income. So let's talk about fixed income. There's an old adage that bonds are more conservative than stocks. That isn't always the case. In fact, there are ways of generating massive amounts of risk with fixed income. But don't want to get into a long, drawn-out conversation about fixed income and risk management. But generally speaking, government treasuries are a lot more conservative than corporate convertible bonds or a strategic income fund or a global bond fund. Also, the average length of maturity. To decrease risk, you can lower maturities. Another area is to increase the coupon. You can buy older bonds that had higher interest rates and are trading at a premium, where you can generate higher cash flows for a lower price at maturity but generally speaking, give yourself some cash flow and buy yourself an ultimately very high quality instrument. Over the last, my career being 30 years, when I look back at some of the major market corrections that have happened during my career, even high quality municipal bonds have been very volatile in price in some of these bad corrections, which was a bad deal for the fact that it scared investors. Some people sold out of those kinds of investments. But worse yet, you didn't have the ability to sell one of those fixed income investments in the bad market at a full price so that you could later buy discounted stock. Ideally, you want some what's called reverse correlation, where you'd be able to take a profit in what has done well in the downturn to go buy the things that are now cheap. So, for example, U.S. Treasuries in the downturn of COVID could have been cashed in for a profit and then turned around and bought a surplus of stocks that were trading at, 30, 50, 70 cents on the dollar. So, increasing your fixed income quality is a strategic maneuver to be used in a very bullish market. I would generally say, too, that regarding new decisions, you have cash, let's say you want to invest money. A lot of people tend to become emboldened by positive returns in the market, much like the person that's winning in Las Vegas. They take on an ever more increasing risk appetite. That is a recipe for loss. Winning generally comes out of bad markets. Winning generally does not come out of frothy markets. Tax losses come out of frothy markets. People make speculative or poorly made choices in bullish markets for a number of reasons. They can be overly confident, or in many cases, maybe somebody wasn't really participating with the bullish market because they were in cash. They've made some mistakes at the bottom of the market, and now they're reluctantly coming back into the market. A lot of bad investments are made by folks trying to play a game of catch up. So part of what you should do when the market is soaring is say no thank you to the more eccentric, riskier assets. Donations to charity. This might be a good time to donate some of your highly appreciated assets. You donate to them, those highly appreciated assets, at full value to a charity, in lieu of you selling it, taking a capital gain and paying taxes on it, and then giving the money away. So donating the asset itself to charity as it's highly appreciated. You can also make donations directly from your IRA account, and it is a deductible item even if you are using your standard deduction. Ask your CPA for more information about the tax qualifications to charity from liquid or investment assets. It also may be a good time, for example, if the markets are frothy, but your ability to buy the car you want, or the hot tub you want, or the furniture you want, or the roof replacement over your head, if it's prohibitively expensive to do it today, maybe a smart choice is to say, well, this is going to cost me $50,000, and simply put that $50,000 into a separate savings checking account, CD, government bond, and say, when the price becomes appropriate, or the ability to get those products and services in a timely fashion at a reasonable price, there'll be money sitting there waiting for that to happen. Another thing that can be done is prepaying of college education expenses for kids and grandkids. Another thing you may want to do is to take a nice trip, or go buy yourself some small things, reward yourself, include your friends and family, and reward yourself for the success that you've had in taking the risks that you did when times maybe were more challenging. So I hope that helps in both protecting the assets that you have, but enjoying the investment dollars that you've earned. I appreciate your time. If you've enjoyed this video, share this with friends or family, and I will see you in my next video. Thank you so much.